Good afternoon, everybody. I'm Dan Hussey with Zaner, Hedge, bringing you our strategy of the week update here for September 7th, 2023. Can't believe it's September already. We've got a new month ahead of us. Could we be finding, seasonal highs and lows as we have a tendency to do within the first week of a month? This is kind of a fun end week of trading that we get to look and explore that idea together. I want to begin today with the soybeans. Let's just hop right into the daily chart of Novi Beans here. Remember, trading futures involves risk and is not suitable for all investors. And everything I talk about here today is just my own opinion and not a direct trade recommendation. But Novi Beans today, taking a step back, in the bigger time frame, I think it's important to note that, okay, we're down 16 cents here. I mean, we settled, I think they're down at around 13.59 and change. Looks like we're going to probably close the day here around 13.60, right into that 20-day moving average, the 18-day, moving average. That's a daily trend indicator that is widely used in the futures market. It's, if you look back on the chart here, you can see how just on an intraday basis, it's generally a good indicator that when we're above or below that line, we're either trending low or below it. We find it as resistance in true bear trends. We find it as support and true uptrends and for the bulls. And breaking back above it here in middle of August, as well as basically all of our other moving averages, was one of our bullish signals that we were looking for this leg to continue higher and potentially be that breakout above $14. And it gave a chance of that, but we ultimately found our way into much larger resistance. I think just this whole crop here, for new crop beans so far have, proven this 1380 to 14 and change, just somewhere up in that area, is clearly that oversold territory for soybeans. It is the point where we are not willing to necessarily break out, because prices have gotten high and we've started a price ration demand, apparently. Production this year, I think justifiably, we could make that argument that we're still nearing and could be close to pipeline, and certainly depending on what we see from projections for Hussey next week, if we don't have if we start hugging that 50 bushel an acre national average and get below it, we start to, without finding acres for beans, we're going to start to really get tight. And we've seen that uptick here, in August here and into September for demand for soybeans as well. So again, I've been kind of, I've been in the camp that thinks that the demand will continue. I think the rising U.S. dollar is actually a show of basically treasuries being sold, dollars being bought, and those dollars will turn around and be used by countries like China to purchase soybeans. That's the nature of the game, and that also results usually in a dollar decline thereafter. So the dollar's being recharged, so to speak, with its purchasing power for our export partners to hopefully, for them to come in and debase our currency and buy all of our commodities out from under us. Well, that's the nature of the game, and that's what we want, for our end producers, That's the demand we want to see. Well, soybeans today on the daily chart trading down, just ticked, below the low, the 3-day low there and the lows of the week. But tested into that 18-day moving average, held the 55-day upward sloping trend line basically going back from May. We're testing all the support at 1360. This has been the line in the sand we've been talking about for a few days now, and since our last report on the soybeans as well. So, not breaking below it today. Have I changed my hat? Have I become a bear? I mean, that's the big question that I think not only, me, myself as a technical trader are asking, but I think the broader market is too. And I think below this cluster of technicals that are very visible on the chart really opens the door, Where is the next support that we even see on this chart? Well, the 200-day at 1331, we've transversed that line a few times. I'm not saying staying above it wouldn't be bullish, but nor would the 50% of this decline around 1345. We'll talk about those levels in the 4-hour chart in a minute, but this 100-day moving average down around $13, as well as just the low end of the range that we've held since June, from 1260 and 1280 lows, roughly. Those are just the rough numbers. It's a long way down. And that's not something we can ignore. You also got to take a look. There could be a left shoulder, head, and right shoulder having formed of a head and shoulder pattern. Neckline would be down around 13 bucks at this point. Below there, that opens the door to 11.50. Do we go even lower still from there? I don't think you can completely rule that idea out, but in the very near term, and certainly into the end of this week, we are setting ourselves up with an interesting support level still holding, where if we do hold, we make yesterday, excuse me, we make today's decline a thing of the past and rally back above 1370 in a hurry. Take out yesterday's high, back above 1380. I think you can make a case, and let's take a look at the 4-hour chart. But before we do, daily RSI isn't quite oversold yet. I would have liked to have seen us go oversold. That would have given me a little more confidence that, okay, this could just be, the market unsettling itself. But anyway, we needed to overwind maybe the overbought conditions. If it turns higher and goes higher, it's got room to the upside is the point. If we come lower and we start going oversold and we're breaking support, it could be the sign and the nail in the coffin for this market has lost itself, exhausted, and is at least probably going to retest $13. But again, we take out today's range, get back above the 3-day high around 1380. Good segue into the 4-hour chart now for new crop beans. On the very short term, that is, the 50% short here from our swing high at 1409 half, and I'm going to highlight that pull so you see it. Right, so from 1409 down to the swing low at this point, that 1383 area, we've been holding it as resistance here. 1360 is clearly support. So you've got this 25-cent range for beans down at lows, well, where we're at, and a little bit of a fight over the trend. Old highs and old resistance that we had broken out of, clustered around the 1330 area. That's why we think we could always come back there to test it. That's also that 200-day. I'm kind of grasping for straws for this middle of the range area, but we did pull back, right? This 1360 area is the 61.8 line of the kind of next in the series pull for soybeans. The full 50 back from the swing from 1281 up to 1409 highs, right? That's at the 1345 area. But the 200-day at 1331 right below it, okay, you can make a somewhat of a case for some support around 1340 to 1330. That would be a very, very dirty level if we were to, kind of swipe down there, hold, and take off, just because of all these others, right? The 18-day, the 55-day, the trend line against the lows, everything else that makes 1360 very visible right now, right, as a support. And kind of a double bottom now here on the weekly chart. Well, you could also, you got to point out the double top then around 1380 to 1385 as well. And again, that 25-cent range that the market's in, I think is very important to the end of this week. And again, we travel back to the high end of that range by the end of this week. Bulls, have found, their step again and are right back in it. But again, we continue lower. And I think tonight in the overnight action in the Asian session from 7 p.m. Central through 3 a.m. Into the, London Open, will be a very important trend distinguishing move tonight for soybeans, because there's some big levels that need to hold or not. Again, all the way down on the larger daily chart below that trend line, really open to $13 in the bigger range in beans. Now you're putting stress on that, what could be a neckline of a head and shoulders pattern, but it's also pull back for a second test, so to speak, of the 1130 to 1435 full, 50% retracement, which is around 1282. We don't love seeing a second test of big 50% levels, but market came straight down, bounced off of it, got one reaction. Maybe it wants to, make sure that that's, the support that needs to hold before we go higher. I don't know. We have WASD next week, where there's a lot of arguments to be made, one way or the other. And certainly right now, the tail end of weather for a soybean crop that I don't think we'll really get a very clear indication until combines start rolling on where yields really are. Just because, hey, I don't disagree with what I hear and what we've seen from the fields and what have you, but what the market says is what the market says. And if we want to go lower and flush lower for reasons that are other than, technical or fundamental, just because there are traders to lean into this at this point, it will do that. All right, so my concern though, again, 1409 highs swing, to that 1357 low. That 1380 area was a 50% retracement off the highs. Down, side targets from that swing would take you to 1345. 1345 is also the 50% retracement from lows to highs. So there's some visibility there, right? If we're going to get a capitulating slide down into a supportive area that, we can at least say, hey, was old resistance, right? The first week of August, 1330 to 1340 was our cluster of highs that we broke out of. We then gapped up there in the middle of August, had that one pullback to 1331, and then rallied, to our highs of September, well, the highs of August, and then have now set up our range for September up in that new range. Well, a pullback to 1340 to 1330 is just a test back to the old breakout areas from August anyway. So from a technical perspective, again, there are some levels there, not only that 200-day moving average on the chart. And it would suffice to say that it would at least make some bears happy that we flushed out and ran through the very visible, trend line, 55-day and 18-day moving average. I don't want to see it go there because, heck, I think all of you know, over the last several weeks, we've been talking about the uptrend in soybeans and where some continuation levels are. We've been looking for this trend to continue higher in the face of fundamental picture that was turning out, right, to be a little more bullish. Well, the market has definitely spoken. The last week of price action has been bearish. We certainly, in the last few days, have set up in a range and contested the downtrend that began on August 28th. But the big $1 million question is, have we just made a low for September, right? Or are we trying to make the low for September now that we're in a new month and going forward? So big level. Wouldn't be surprised to see the market try to find lower support. 1345 to 1330. There's some argument to be made there, but below there, really, why not back down to $13 to 1280 again, right? It's just the bigger range. And this market is, until it has a clear reason to trend, markets will just trade the book, so to speak, or trade between their support and resistances, consolidate, be sideways, be range bound. And boy, have the last several months for the row craftsman a lesson in that. All right, December corn actually closing the day positive, but did we settle positive? I'll have to check. I think these might be the settlement prices. Oh, they are, because 59.5. That's where the soybean settled. So the one green spot on the board until you get into cattle markets is the December corn there on the day. I don't know how that makes me feel. I remind myself to go look at how tight the trading range is, and that reminds me that take everything with a grain of salt right now. Okay, we're still, but we actually closed the day above that 18-day moving average at 484. Okay, so does that make me a bull? I don't know. Everything about corn right now is slowly building and at least making me feel like there's a need for some short covering. But whenever I see consolidation in this pennant-like structure or triangle, right, or sideways in a range at lows, you have to at least give some credence to the idea that we'll want to flush out the low and capitulate, or just continue lower from the bear pennant that we're ultimately in while below $5. So I'll really become more convinced on December corn back above 5. I think that's where the bigger technicals picture flips. I think that's where funds will start to cover just the psychological nature of being back above $5 after trying so hard to break below it. I think could flip the script for some short covering just from that nature, right? Plus, at that point, you're getting pretty close to your 55 and 100-day moving averages, which are up around 520. And why not retest the 200-day up around 530? Or 553, excuse me, at that point, once you've really, started to get a move going higher. But if in all of this we can't, get a rally going, the path of least resistance is going to be lower. And soybeans have had the weather markets I have felt to have justified that. I feel for whatever reason, corn is unwilling to motivate itself and get going as well. But it seems like we're waiting for something. But this bottling up against 480, if it doesn't get going lower soon, we're going to have these short covering. These were weather driven short covering rallies, but there's going to be other reasons for short covering to come, and sometimes it's just reversion to the mean. And I think, other than more than anything else, I feel like that's why I'm bullish corn. I'm bullish corn just because this thing just can't go down. Every time down to below 480, it just kind of creeps back up. At what point does it do one of those very quick pops? I'm not saying that I'm bullish to the fact that I think we should go to new contract highs for December corn. I don't see that on the table without some other big dynamics changing. But the ranges we've been in, I see no reason why, and the trade having really put a foothold in so far, I see no reason why we can't see some short covering and provide an opportunity to do some selling and to have some better sales still on the horizon. But I do think you get above 520, 550, you got to be thinking about structuring into cash sales if you haven't already. Does it hurt to be long $5 calls? Maybe sell 550 or something above. The idea of how can we limit our risk and be long this market down here? No. I think that there is a reason and an argument to be made there. But I also think that if we don't get going or after rallies, we could fall back below 5. And if and when we do, it's just going to be met with panic selling. And that's how we could get back to 380 corn. And I know, how dare I say something below 4, but just there is a path back there, right? I'm not saying it's straight, but demand's not there. We continue to find acres. We continue to have yield better than expected, and then into next year have no issues into planting well, and then a big crop and monster crop out of South America and in the United States next year. Well, there you go, right? Now we're talking like doubling the pile of corn we have now. I mean, we're right. I mean, that changes things. Again, equally though, you have to talk about the other side of the equation. I think it's harder to talk about the inverted conditions we will continue to see in soybean markets where there's that demand that's going to continue to keep prices where they are because of our stock to usage ratios. But either way, let's take a look at the 4-hour chart of corn. Because truthfully, there's not much else to say there. You could talk in circles, I guess. Open gap around 531 still on this chart that I think we will get up into. I think that's your first kind of upside target that I want to see this market, revert back to test towards, and that would be a move to retest again that 55 and 100-day moving average. It would also be a breakout back above $5, and I think there's some downward sloping trend lines at this point that the market's still kind of respecting. You can see here on the chart, but we're also really pushing up against it. So even in the near term, back above 490, why don't we'll probably retest $5, and now we're talking a breakout of this $5 to 510 area. You can see the cluster of old highs that we have seen on the chart here over the last several trading or a couple weeks, that back above, there's really nothing, I think, back of the way until this old resistance, this old gap, and the 50% retracement of that swing from 572 down to 473 at 522. Okay. Downward sloping trend lines would be broken out of, and we'd be setting up into new ones. And honestly, then I think we could really talk about this 470 to 490 low end of the range. And then a new high end of the range, maybe, up towards 572, the highs of August. Talk about 629, the highs of June, or sorry, the highs of July, the highs of August, which is only at 520. I think that is definitely the first target. But again, the highs of July, I think, we're going to be the real fight will be. And you're going to have to do a lot of convincing. I think we had the weather or a potential for it back here, but unless we get really surprised by how combines run here in the fall, which we could, I think that's how we push above these levels at 580 to 630. We're going to need see some major adjustments come October, but that's still a ways off, right? into Friday's report or next week's report, we don't have as much to grit our teeth on. So let's actually take a look at that now. Thanks to Karen Braun from Reuters, putting out some great data as always on and collection of data as always there on Twitter. Give her a good follow there at KANNBWX. But crop production in the WASDE next week. Trade estimates for corn yield coming at 173.5. Soybean yield 50.25. That's a reduction on both accordingly. Harvested acres going up a little bit there for corn by 0.1. Going up by 0.2 there by the beans. Obviously, both of those numbers, I think there's been a lot of talk and rumor mills about how much those could shift. And, the FSA numbers have spoken, and we'll see what the USDA has to say and if they acknowledge some of the change we've seen there. Total production reducing there on soybeans. I think that getting below that 420 area starts to really remind us how tight soybeans can get, and again, that brings our stock to usage ratio and our are going to really bring down that carry out quite a bit. Anyway, still above 15 billion bushels there on average production expectations for corn. I think below 15 it starts to get interesting. I think though corn's got to really drop down to the 170 area before you start to get interesting in terms of a yield estimate. But if you're not below 50, in my opinion, on the soybeans, the market might be a little disappointed, which is even though average trade expectations at 50.25. The trade has gotten, and you can see it on soybeans. I mean, Twitter sphere and social media has gotten incredibly bullish, and anything in these types of attitudes, whenever anything's a disappointment, it's usually pretty nasty, or it can be. Chicago wheat today finished down 9 cents there in the SEP, but the December contract there closing back below $6. Kind of a different look depending on where you look in the wheat complex. KC wheat, and Minneapolis spring wheat in the December, both higher highs and higher lows, where Chicago, was not. Basically, another kind of double bottom, but technically a lower low and lower high there in Chicago December wheat. And finding resistance, it kind of appears right into that 18-day moving average yet again, whereas it hasn't quite got there for Chicago. Spring wheat and KC wheat have both have gotten up there for a good test. This would be, the area on the wheat chart that if we can't get back above, this 3-day high that we're forming right now, and this is true of Chicago, KC, and spring wheat. You can't get back above those levels. It just, they just make themselves out to be the next in series resistance, right? You can draw trend lines against the highs. It's the 18-day moving average. Here for Chicago wheat, it's 607 is the old low from June that we're below, and now we're unable to break back above. I mean, nothing about that looks great, but you get back above those levels, and now you flip the script, which is why we talk about them here, right? Because those are the levels you want to reestablish. It's how the market picks itself back up, reverses a trend, and starts walking in the other direction. But as of right now, the trend's continuing lower on the daily chart of Chicago wheat. You can make a case, right, that at least intraday on our KC wheat and our Minneapolis spring wheat, it's higher highs and higher lows still. Into tomorrow, we'll see how they close, yada yada. But hey, all of our row crops here seem to have started the day off looking a lot better than they finished, and that puts us into a very interesting Friday's, worth of price action here, with WASDE around the corner next week. You can make a few cases for a number of things that are going on. But not much else to add to wheat there until we kind of like corn start coming up. All right, cotton, December cotton, really nasty sell-off. This is the third really bad sell-off we've had since July. after really strong markets, I would say, right? The markets that look like we're starting to break out and trying to make our way towards big levels. Well, we did, right? Cotton broke out of old trend lines. It came back to test those trend lines as support there, July through August. We've started off here with September making a high and pushing for a test towards 90. Now we've pulled back. I was hopeful to see us hold, 88 to 86 area and then, continue through 90 and towards 100, what have you. But we're back towards, old resistance levels and downward sloping trend lines on the chart that seem to be holding. All right, so pullbacks have come back down now to test the 18-day moving average. We're actually closed here below it at 86.19, closing at 85.38. Cotton has a tendency to do this. When it does, it may spend a few days below and then quickly get back above, or only spend a moment below like we saw before. But this is the first warning signal, right, that a trend might be reversing. Other than the 2 days of really hard selling pressure and being down $5 off the high, right? But upward sloping trend lines against the lows all converge right around this 85 area as well. However, most of our major moving averages, like the 55-day, are still well below us at 83.84. That aligns with the low end of the range that we are holding through July and arguably maybe started to break out of, but are now back within. And of course, that could suggest the market wants to go back and test that old range low around 83.80. So that's our next kind of big area on the market of support in the market. The downward sloping trend lines against the highs that we broke out of converge right around this 82.60 to 82.30 area, right where that 100-day moving average at 82.71 is, and the 200-day at 82.30. That would also basically be a 50% retracement from 76 lows from the summer in June to the 90 high we just made on the December cotton chart. 50% would be right around that area too. So, boy, just like the beans, just like the corn, everything kind of right at support, that if it doesn't hold the levels that we're at now and oversold on the daily RSI there too for cotton, if we don't hold here and quickly hurry back above some of the support or the quote unquote bullish levels, like being above that 18-day moving average that we were just a few days ago, right, this looks very bearish and looks like the market flipping and turning around. I don't think there's any indication that cotton and soybeans are going to do that together, but it's just interesting to note that everything for this first week of September is really has not only found a pretty substantial high for some of these markets, but is also now trying to find a low end of a very decent opening trading range to start the month. All right, in the cattle markets, October fats, 183.65, continuing yesterday's strength and breakout of the downward sloping trend line, and arguably, what was a bull flag or a bull pennant on this chart that was forming from about mid-July. Found support there at a couple tests early on at 178. That then quickly became the 55-day moving average when it came up to meet it here a few weeks back there in the middle of August. Broke above that downward sloping trend line in yesterday's price action. There we go. Which you can see on the chart here around 181. Today, a little bit of a test back there. I mean, 182, sure, you could, at least on the daily chart, it looks like it, but I would not be surprised to see today's lows be challenged again. But this is a breakout for all intents and purposes, in my opinion. And the channel higher should take us to a move towards 190. I mean, who would have thought back in April, right, when we had already rallied to 165 to 170, and we were saying, wow, this is a big move in cattle, that we would still be 20 higher, 20 full handles higher since then. And really not giving much back in the way of a pullback. This was a pretty distinguished bull flag, and now the market's trying to test contract highs. 18-day moving average and the 100-day move or 55-day moving average there, almost crossed over, but didn't. It just kind of kissed there around 180, right where everything kind of came to an apex of that or came to that tightest point of the triangle, and then boom, market has kind of spoken here. So again, upside projection, I think towards 190. You can take and try the box method here, right? You take the range or the distance of the triangle, the range here from 185 down to 177, and extend that from the high end. You'd expect the the breakout to take you towards 195 on the high end, or a whole box higher, 100% extension for its legs, or a good target to the upside. So keep an eye out for that. September feeder cattle 255.57. I think we got new contract highs across the whole feeder spectrum there. So feeders leading the way, as would be expected, I suppose. Also had a bit of a sideways range for the September feeder between 254 there and 244. That 10-point range has a box or an extension above that could take us up towards 264, right, from the high end of the range that we're in. If you follow trend lines, and certainly the channels that we're following, they tend to agree with that level, as you can see here on this chart. Nope. Oh wow. There we go. Upside projection from a channel right now, just on the September feeders, are taking it towards 268. So not the time to kind of be picking a top, but certainly to be thinking about put protection, getting a floor for those cattlemen out there in both the fats and the feeders if you need it. This is where puts are cheap, and can keep that top side open and allow this trend to continue to rally. Because I think we all know that once the conviction in the bull market runs out, and if there's any reason for cattle to pull back, there is a long way down to where support can be. I mean, for example, the October fats, that 168 to 175 area, there really is not much in the way between those levels. It was great to see it rally through it, but if we fall back down there and go below, it can go back down just as fast, or if not faster at times as well. So we alluded and talked a little bit about the dollar, well, earlier in the video, breaking back above downward sloping trend line here, that really occurred into the end of August there. A move back above the 200-day moving average, a pullback to test the 200-day and 18-day moving average around 102. Has just continued the dollar trend higher. The 50% retracement for the swing high from 114 to 115 area down to the just sub 100 around 99.50 is 106.60. So we still haven't made it back 50% of the entire decline so far. When we take a much bigger step back on the dollar chart, though, we know that we're down testing old resistance, now potentially support from the old range that the dollar was in between roughly 88 and 102. Call it a 10 to 12 point range that we are in for the better part of a decade. Is this the market trying to break out of that, make a new 10 to 12 point range above? Maybe. But I think rejection here below 106 to 105 and a move back down to 100 and below would kind of take that wind out of that sails. But for right now, and certainly from the test back towards 100 on the Dixie, there seems to be a pretty good uptrend, and that's the dollar Dixie here is this the white line. We can use a candlestick chart here. That's fine. I was looking at a line chart for other reasons earlier. But we're basically right. If you really just take the price action for 2023 on the dollar index, we haven't made it back to highs of the year yet. And this 105.80 area has been resistance every time up. So we've been in a range between 100 and 105. 80 and change. It's an impressive rally for the dollar, but could we be running into the area where we're going to find resistance and it rolls over? I don't know. Commodities seem like they've all gotten beaten up, and if the purchasing power of export partners has gone up by about 5% since July, they may take that as an opportunity to cash in those dollar coupons at the dollar store for commodities. At least I hope they do. And that's a trend we saw back in, past years as well. And generally speaking, when you see bond markets selling off and the dollar rallying and commodities sitting still, I usually wonder who is, getting ready to, start buying U.S. commodities with those now more valuable dollars. At least I hope that's the case because, hey, many people I know rely on that very demand. And we'll continue to watch that. Little bit of an extra look today, and this is why I was looking at a line chart. So let's put back that line. I was looking at Gulf Coast urea charts because fertilizer here has come back into the forefront of my mind. There's been a lot of talks over the Black Sea grain deal and Putin wanting to hold back fertilizer unless or unless he gets to sell his fertilizer, he's not going to be entering into a new grain deal is effectively what I had heard last. Okay, so now we've got fertilizer for grain being used as, chess pieces. And I think, everyone was aware at the start of this war what the results on fertilizer prices was. And if we look at a continuation chart of Gulf Coast, and this is just spot month, front month really, Gulf Coast fertilizer, you can see the run up right to 8 to 900 there in the FOB market, all the way up, highs during the original invasion. The market has then, seen that deflationary or that pullback. Actually, this looks like a chart of wheat in many ways, right? And a pullback in urea prices all the way through, the lows in May. Well, we are well off those lows. And over the last week, in fact, we have rallied significantly, from basically 350 back to 410. And a move back above 400 here, brings us back to the question, are we going back to, 500, right? We're getting above the 200-day moving average. We're getting above the 18-day moving average. For all intents and purposes, to me, this looks like a market reversing and breaking above some big daily levels that are fertilizer prices about to, run back up to their highs. I don't know if they'll go back to the highs of last year, but certainly if there's a chess piece on a macroeconomic level to be played here, this is where, you might see it. And if this chart, I don't know, when I go and I look at a chart of wheat, per se, it looks very similar in many regards in the decline we saw over the same period. And I think that's, because of the headline, being attached to the Ukrainian-Russian war. But we are seeing a reversal, in my opinion, in those FOB Gulf prices for urea and, every way I technically, can kind of look at this chart, even though the data is very hard to read because it's really gives you a daily quote. But as a line chart here, it looks to me that we're making a move and a sustained move back above 400 is going to continue to keep some pressure on that year from the bulls on fertilizer prices. Okay. Crude oil, and then we need to wrap this up today. I guess I got a little bit to say about the stock market too, and in the equity indice futures. But back above for just the October contract in crude, back above that 82 resistance, right? I think pullbacks towards 82 to 80 are not out of the question. It just moves back towards upward sloping trend lines to old highs, breakout highs, and this 50% swing from the 77 lows of August through now the highs of September at 88.08 is around 83. You look at the continuous contract for crude, you can see how we are in a channel higher. At this time, it kind of bumped into channel resistance. Channel support comes in around, 80 to 78. It'll probably be much higher if we don't go straight down there. We've broken above downward sloping trend lines around 76. We pulled back to kind of test them there at the lows of August, and September has started off strong. But are we making a high for, in the seasonal chart for September at this point is my concern. Because within this first week of trading, I usually look for, highs and lows to try to, but for a whole month to potentially have formed, or at least for an extended period, to get kind of the trading range going. So we're going to watch out this old high, this 81 to 83 area of resistance basically for the whole year so far. We're going to want and need to see the market stay above that, which, aligns itself with the lows of the month. So, all right, September, crude, if we're going to hold and you're going to continue higher, that 83 area seems very, yes, you can give it some leeway down to 81, but we really need to stay above that broken resistance now support. And set up in a new range, which could take you up towards 90 to 95, and the much bigger downward sloping trend line that the market has otherwise been in from last year, and from the highs there from peak crude around 130. So lots of talk now about the SPR being refilled. It's been drops in the bucket so far compared to how much they sold, but if this was if the sell-off was the release of the 230 million barrels of crude, if they only bought like 2 million back, and we're up that much, oh boy, this is going to be very painful to buy back the other 227 million barrels if they're going to refill it back to its the amount that we had in previous stockpiles, which I don't know if this administration is up for doing, but I don't know. A breakout back above 90 really calls into question this entire swing. COVID low for 6.5 on the continuous contract. We all know that actual spot crude prices in the futures went negative because there's no place to store it. They had to build out storage. So, hey, you're paying for it in the crude. The 50% retracement from the 650 low to the 129.97 high, 68 area, right? So we held that 50% retracement. A swing, just from that technical move could take you to 159. If fundamentals continue to support it, if the U.S. wants to refill the SPR, if the rest of the world keeps cutting supplies and demand stays strong, well, at peak gas prices, back at peak inflation, we only lost about 7%, if memory serves, of demand. There's a long way to go. Long way to go higher here for crude prices until we start price rationing out anything. So we'll see. But again, pullbacks towards 83 to 82. We'll keep an eye on that for support. But at this time, I think the trend is entrenching itself for higher prices. I talked about the bond selling and the sell-off earlier today. Just again, it just looks like a continued trend lower. There's a definite trend channel here going on. 30-year sold off over the last several sessions off their highs of the month around 121 back to 119. Not much to say here. I think we're just going to continue that lower until we don't, right? Until there's a reason to start buying bonds again. Otherwise, I think we're starting to try to force the Fed back into a wall that, hey, price inflation may not be totally over with, and you guys need to continue down the road you are. Gold prices continuing sideways in a bit of a range, but I think this 50% short off the highs is in 2 degrees kind of here, continuing to hold. So we break below this trend line around 1930 at this time. I think that's going to continue lower towards 1834, towards that 1850 area, and ultimately a bigger 50% pullback of this larger swing. But I'm concerned, with buying that and just saying, oh, I'm going to be a buyer there. I want to see it and need to see it trade, because this is really just a pullback in a larger range. Gold could get back down to 1,600, and boy, wouldn't you rather be a buyer down there? And I just say it because that's the range we've been in. But certainly I'm a lot more bullish back above 2050, 2021, the highs of this range, and back above this downward sloping trend line around 1980. Could we do it? Yeah, this is consolidation. You got lows to put risk below. You got highs to put risk above. Everything in between is just going to be a boxing match. But back above 1980, I get a little more bullish on gold. But below 1930 here, I think it's got almost $100 lower or higher in either direction above those levels. We'll continue to watch that, but not much to really do or say in the meantime. The S&P kind of interesting, pulling back into full 50% retracement from the 4350 low to the 4547 high there. That 50% pullback towards 4450 has an upside swing target of 4594 if it wants to kind of achieve it here. It's kind of a back and fill into the broken resistance downward sloping trend lines that we broke above. pull back into them. So I don't know. Maybe this is the support before rally to its 4,600 and beyond. I mean, there's kind of a quick pullback there from the 46.34 high down into the low at 43.40. I can make a case for some upward sloping trend lines there. Pull back on the daily chart. Here's how we got the 50% level. It's the original 50% long. So the swing from 35.02 here off of that low to the highs after, there was an initial 50% long. You can see it right here, right? Pulled back 50% long. We've gone to its target of 43.31, and we actually broke out above it, right? Went to the secondary target. So going from the highs of that pull to the highs after, which you can see the swing I just highlighted here, 41.80 highs to the highs after. 44.06 was the 50% level there. 43.53, that 618 line is basically held. We then rallied up, went through 618 lines of any kind of counter, swing, the highs, the lows there, and then drawing up the low to high thereafter. It seems to be holding. So back above today's high, I think, gives you a little bit of a key reversal and opens the door for testing this downward sloping trend line against the highs around 520 and onwards to 594. That could continue higher though. 47.40 upside targets while we're above 43.50 in the S&P. If we get below 43.50 though, there's not much in the way. That doesn't open the door down towards the 4100 area. A test of these old broken resistances would be now support and some other bigger trend lines on the chart. And that would almost be a healthier pullback for the longer term, but the channel and the supportive trend lines that we're holding currently suggests that today might have been an entry for another swing to highs and for highs of this month and beyond the highs of the summer, which would then start to talk about contesting the all-time high, which is not that far off. So, all right. I mean, I guess the moral of the story is, right, still bullish the S&P well above a few key levels there. Our row crops, soybeans in particular, have some very interesting levels to check and continue to watch here in the very near term. Cotton is much the same way, interestingly enough. Wheat and corn, there are definitely reasons and arguments to be made in either direction, but nothing has compelled me to want to really take a major stab anywhere. I think, into the report next week, and looking at where fundamentals lie, there's some, again, it sounds like a broken record, but this does seem like the year where more risk adverse strategies like using long options tend to, I don't want to say reward the trader, but tend to cause less damage because in these sideways markets, it's very hard to trade futures unless you're scalping for pennies. And certainly, I think we're kind of building to a point where we're going to see a very big move because we haven't seen one in a while, right? Corn has gotten, the volatility index on corn, wheat, and beans has gotten really low. And futures markets don't sit that still forever. And there's been a lot of arguments to be made for the market to be moving in one way or the other, and it hasn't. So at some point, the powers that be, the arm wrestling match, one side's going to, give way. And I think there's going to be a substantial move in either direction. And it might be in both, right? You might see some whips on some head fakes, maybe more so, for corn and beans than anything else. But because of the middle of the range type trading we're seeing. But nevertheless, we'll see what tomorrow price action brings. And next week's WASDE report as we get some more data dump on this market. Be sure to check out, if you guys haven't already, our daily call in, our Ag Hedge hotline with our Chief Market Strategist, Ted Seifried, bringing you our up-to-date daily info and market insights and a concise audio there, our audio for everybody to be able to enjoy and check out. Links for that are available in the comment and information section here to sign up and get a part of that mailing list. And of course, always check out this weekly webinar, the Strategy of the Week webinar. You can find me at Facebook and Twitter. My number on the screen here, 312-277-0110. I'm Dan Hussey with Zaner Ag Hedge. This has been our Strategy of the Week for September 7th, 2023. Have a great day, everybody, and we'll be back with you as price action develops.